Hi, I'm Audie. Welcome to our visual guide to modern quantitative finance, where we are decoding Quant to explore the data-driven approach to investing. In this video, we will look at how the financial industry is fundamentally moving from human intuition to algorithmic logic. The core shift taking place right now is a transition from gut feelings to predefined rules. Traditional investing is moving away from intuition and narratives. Instead, quantitative, or quant, investing operates entirely on data, logic, and automated execution. These are two distinct worlds of capital allocation, and quant investing doesn't just use different tools, it asks entirely different questions. While traditional investing asks which specific company to buy, relies on manual research, human timing, and diversifies across asset classes like stocks and real estate, quant investing takes a different path. Quant asks which mathematical logic and numbers consistently win, executing automated daily adjustments based purely on strategy parameters, and diversifying across multiple non-correlated algorithmic strategies. The secret to this approach is that quants don't pick stocks, they pick rules. If a quant builds a strategy designed to find companies with growing operating profits, the algorithm will automatically buy whatever fits that criteria today. The algorithm simply does not care about the company's name, brand, or the current market hype. However, quants know to never rely on a single formula. Just as traditional investors shouldn't put all their money into one stock, quants never rely on a single algorithm, because a single strategy always has blind spots. True strength comes from strategy diversification, where quants submit multiple, complementary strategies to work together. By combining opposing logic, they can smooth out returns and dramatically lower risk. To survive the storm of unpredictable markets, many quant funds use the mechanics of market neutrality. They often utilize a long-short equity structure to detach their returns from broader market crashes. This involves a long position, betting that 50% of stocks will rise, and a short position, betting that 50% of stocks will fall, ultimately working toward an absolute return regardless of the overall market direction. There is a massive algorithmic advantage in human irrationality. While highly efficient markets are crowded, inefficient markets driven by emotion or strange trends offer massive opportunities for algorithms designed to exploit those exact inefficiencies. A great example is the typhoon effect, where retail investors in less efficient markets might irrationally buy a paint company just because its name sounds like an approaching typhoon. A text similarity algorithm can easily spot and exploit this completely illogical price movement. Of course, there is a dark side to data, and there are traps that can break algorithms. Having access to massive amounts of data does not guarantee success. In fact, the most common pitfall in algorithmic investing is building models based on flawed historical perspectives. One major trap is survivorship bias, often seen in the M7 illusion. If you backtest an algorithm today using only companies that survived to dominate the last decade, your results will look like genius with a 100% win rate. But it's a trap, because 10 years ago, today's winners were unstable, and the dominant group was entirely different. A real strategy must account for the historical universe, which includes all the companies that eventually failed. Another trap is data snooping, which is essentially torturing the numbers. Data snooping, or overfitting, happens when a researcher runs tests over and over until they accidentally find a result that looks perfect in the past. These overfitted algorithms look brilliant on historical paper, but completely fail in the real, unpredictable future because they memorized the past rather than actually learning true logic. So, can generative AI build winning quants for you? The answer is not quite yet. Large language models train on public internet data, but the most valuable financial data and winning strategies are fiercely hidden by hedge funds. Once this alpha is exposed to the public market, it loses its value. Currently, AI is best used as an advanced coding assistant to build your ideas, not as an autonomous oracle to pick your stocks. There is, however, an ultimate algorithm for the retail investor. Institutions are forced to constantly juggle tactical asset allocation because they cannot leave cash idle. But retail investors do not have this constraint. For everyday investors with a steady income, the most reliable algorithmic approach is automated dollar cost averaging, or DCA. You don't need to time the market, you just need to feed the system consistently every payday. When building these systems, it is a myth that quant is purely about complex math and coding. The anatomy of a successful quant strategy relies on code simply as the tool that executes the idea. True success requires coding and execution, deep domain knowledge of economics and market behavior, and clean data that actively avoids biases like survivorship bias and data snooping. The exciting news is that the vault is opening, and quant is becoming democratized. Historically, institutional-grade data and backtesting environments were locked behind massive paywalls, but today, that barrier is rapidly dropping. New AI tools are offering advanced quant screening functions. Hidden financial data is becoming increasingly accessible to the public, and everyday investors will soon backtest and link complex strategies directly to retail accounts. Ultimately, quant is a new language for investing. It is not just a mathematical trick, but rather a completely new way to interpret the financial world. By stripping away human emotion, noisy narratives, and hype, quant allows pure data to speak for itself. Just remember, investing in options involve risk and aren't for everyone. So treat this as an educational guide for your financial journey. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.